Hi, tax-free loans to employees. So we'll look at both loans to employees and tax-free loans. So you can loan an employee money from your company, which can help them with cash flow problems, and you can choose to charge them interest or not. That's at your discretion. From an employee's point of view, if the loan is £10,000 or less, this is a tax-free benefit. In other words, there's no tax, income tax or national insurance that the individual would need to pay to HMRC. And so it's a very tax-efficient way of lending money from you as an employer, and it helps retain your staff. I think the only caveat there is, as an employer, you need to ensure that you can afford, from a cash flow point of view from the company, to lend out that money. But say you can, and say you lend an employee the £10,000 last tax year, there's no tax benefit. If you lend them then a further £10,000 in this tax year, so overall there's £20,000 outstanding, the whole £20,000 is a taxable benefit. So you need to be really aware of the £10,000 cap, but also you need to add up a total of all loans that are made to the employee. So it's not just each individual loan. So you can't lend the client, say, 5 individual loans of £10,000, because that'd be a £50,000 taxable benefit. So that's what you need to watch out for. Often this is done where an employee has, say, a season ticket for travel purposes, and often there's a substantial cost saving for someone to pay for, say, quarterly or an annual travel pass than it is to pay for it as you go, or say weekly. So that's often when the advances can be made. So you need to be aware that the £10,000 is your cap, and it's a total of all loans to that one individual employee. As an employer, you can decide to charge them interest or not. That is at your discretion. The next bit I want to look at is what's classed as a qualifying loan for an employee. This also catches business owners, directors and partners. And what we're saying by qualifying loan is that it means that any interest that's paid on that qualifying loan is a tax deductible expense of their income tax. So, for example, an employee takes out a loan, and that loan could be from yourselves to, say, buy some IT equipment that they want to, say, work at home, and that's something that the company won't pay for. As long as that employee uses that equipment 100% for work purposes, so wholly for work purposes, then the interest paid on that loan to purchase the equipment is a tax-deductible expense. So, for example, say the employee's employment income was £50,000 a year. They'd taken out a loan for, say, £1,000 to buy some equipment, and in the year they paid, I don't know, 30. So, for ease of numbers, let's round it up. Let's say £100 interest during the year on that £1,000 loan. That £100 interest is tax deductible. So if their salary is £50,000, they deduct the £100 interest that they've paid for the qualifying loan, and then therefore they are taxed on the remainder. So there's a slight tax saving for that. If the equipment was partly used for work purposes and partly for private, so 50-50, then you would allow 50% of that loan interest as a tax deductible expense. The most common times, though, we see this is where a director or a shareholder, should we say, will purchase some shares in a company. Now, if that's a closed company, and a closed company is a company that has 5 or less shareholders, so small to medium-sized business in most cases, if a new shareholder is coming in, so you may have, say, an employee that's now going to become a shareholder in another company, or an external investor that wants to just invest in the business, and they borrow money to be able to purchase those shares. So like fees of numbers, so that their investment and their share capital is worth £100,000. They take a loan out from a bank for £100,000, and they're paying interest on that loan. Then they can that loan interest is again tax deductible. So if, say, their income is £50,000, on £100,000 they're paying more interest, that reduces down their taxable income. So they get the saving at 20% or 40%. With it being a closed company, they must either work for the company or have more than a 5% shareholding to be qualifying for it to be qualifying loan. But you could also do it where you're an existing director of a company and say you want to invest in some new software or some plant and machinery. You can, or you might just want to take out the loan for working capital, so you know you've got enough to see yourselves over for next year, and you might have some new acquisitions and purchases to make. If you take out as a director that loan and you are paying an external bank interest for borrowing that money, then that interest is deductible off your self-assessment tax return. So that'll be deducted off, say, your salary and dividends. So that's something to bear in mind. That's a qualifying loan, so you get that tax relief on that. And the most common one that I would say is generally accepted is when it's a partnership. And it's an existing partnership and someone wants to buy into the partnership. There's obviously a capital that they have to put in, and that capital, can be any sum, but for example, it could be 150,000, 200,000 pounds. They buy into the partnership, and again, any interest that they pay on that loan is a qualifying loan and is tax deductible on their personal self-assessment tax returns. Nothing to do with the partnership. This is the partner that's buying in. So that's just things to think about. It reduces your tax bill, reduces your employees' tax bill, any potential investors or shareholders. And so it's worth looking at to help save the tax, and also that those funds that are coming into the business will help the business potentially grow, diversify, or invest in other areas. I hope that helps. Please click subscribe and like this video, and any comments would be welcome. Thanks. Bye.